Well, good afternoon, everybody, and welcome to today's presentation. This week, in our series of presentations, we are covering growth and value strategies. And today we're hearing from Allianz Technology Trust. We're joined by Mike Seidenberg, live from Silicon Valley and lead portfolio manager of the trust. Mike heads up the five-strong technology investment team and has been lead manager since July of last year. Those of you who are scheduled to attend many of these lunches will know that slightly later start time, which is to account for Mike being in the global hub of technology on the West Coast of America. ATT slipped to a wide discount over the past year as the sector has come under pressure from rising interest rate environment, although Mike and the team believe that structural trends in the sector remain intact. This includes large weights to the likes of cybersecurity and semiconductors. I'll hand over to Mike to talk through the trust in just a moment, but first of all, a little bit of housekeeping. You'll all be muted during the presentation, but we will have time for Q&A for about 15 minutes at the end. Please use the Q&A function at the bottom right of your screen to ask questions. We'll sort through those, group them together and address them to Mike at the end. So now, without any further ado, over to you, Mike.
Great. Thank you for your nice introduction, and thank everyone for their time today. I realize people are busy. Appreciate the late start. It's actually a really busy week here in San Francisco, given that it's the Morgan Stanley Technology Conference. And I was just saying earlier, before we got on, that it's just great to be back in front of people after literally almost 3 years to the day for lockdown here in San Francisco. So with that as a backdrop, let's get started. So just kind of thinking about the trust, and I'll just spend a couple minutes on me just so you understand who I am. My name is Mike Seidenberg. I'm the lead portfolio manager for the trust. I've been associated with the product for the past 12 years. Took it over in July of 2022 when my partner retired. And, philosophically, as we think about the multi-year journey of tech investing, one of our key tenets is just really kind of thinking about technology investing and why it is a winner's game versus a loser's game. And I've seen that in my career. My background is actually I worked at Oracle Corporation after business school many decades ago. But when we talk about technology being a winner's game versus a loser's game, what we mean here is new subsegments are constantly created in the technology landscape. I witnessed it myself when I worked in software, where you had the software line item budget for a chief information officer, and out of that was born the software as a service budget. We're seeing that today in multiple aspects of the business when we think about things like cybersecurity, right? When I worked in technology, cybersecurity was part of the software budget. Now, cybersecurity is its own line item and garners IT budgetary dollars every year. So that's what we mean when we talk about it being a winner's game. That manifests itself in other aspects of the business. If you think about semiconductors, if you think about, generally speaking, on a bill of materials, you're seeing more and more semiconductor content, end up in these products. And therefore, that's this notion of a winner's game. But it's really important from our perspective that you understand this dynamic, and therefore you can position yourself to be in those sectors that are garnering that either bill of materials spend, consumer usage, or enterprise budgetary dollars. So we think that being in the Silicon Valley really puts us in the forefront of that innovation cycle. And we really kind of pride ourselves in making sure that we're thinking about where are those winners emerging. Looking at our track record, we have a proven track record with multi-decades of experience. The past couple of years have been tricky for the trust, but I'd like to remind our investors this is a multi-year journey, and with a multi-year mindset, we're really confident over time that our process should lead to good results for our shareholders. Our process is a consistent process that's really focused on stock selection, but also understanding that it's an iterative process as well, and that we're always trying to improve it. We don't rest on our laurels. Proximity to Silicon Valley is really a competitive advantage that we've really kind of really focused on over the past, in my case, 12 years with the trust. So it's not just the Silicon Valley, but I think it's important to go and kind of touch and feel the companies you're investing in, and we really are fortunate in that many of those companies are located really nearby our office in some cases. Ironically, true story. I was walking back from the conference yesterday, and I ran into Parker Harris, who's one of the senior executives at Salesforce.com, and he pulled me aside on the street and wanted to know my thoughts. Parker and I go way back. Both professionally and personally, and he wanted to know my thoughts on the Salesforce quarter, if investors really understood that they being Salesforce.com has religion around cost cutting. So there is a serendipitous aspect to the job, and I think being in one of those centers really helps. It was a great conversation with Parker, and it really feels like the company has conviction around kind of being a more financially disciplined organization. So that was a great conversation. Very random. This is the team. I'm the lead portfolio manager. Every decision that is made with respect to positioning and buying, selling, execution is done by me, but I don't work in a vacuum. I work with four really talented team members, where we're constantly bantering back and forth around stocks. We have a call every day of the week. I was just on it earlier this morning, where we were all talking about the meetings we took yesterday at the conference, coupled with CrowdStrike reported last night. CrowdStrike is a cybersecurity company. They had a nice quarter. And we were talking about this morning kind of what the risk reward was the stock. So we kind of believe in this notion of collaborative aspect, but also a really understanding at the end of the day, you need a single point of accountability. So, when CrowdStrike reported last night, I interacted with Rich Gorman on my far right-hand side, or on the far right-hand side of this slide, who really spends a lot of time in cybersecurity and is the point person on that stock. I really enjoy my teammates. I'm getting a message that the slides are blurred, FYI, to the folks at Kepler. I don't know if it's on my end or on the system end. At any rate, as I was saying, a team of five, very dedicated to focusing on technology investing and at a subsegment level. So, understanding that technology is kind of a life cycle journey, and that there are times where things are great. Now the slides look fine. I will disregard the slide comments. Um, uh, Understanding just what is the journey of technology investing, and especially now, you might be asking me, so why should investors be excited today? Well, I like to remind people that the technology investment journey is a multi-decade one, right? If you roll the clock back, at least in my case, I can remember, my parents, sending us to Apple IIc class when I was a child, and that was just kind of the beginning of this kind of consumerization of technology. And there are really exciting things happening today. But as I alluded to, technology is a life cycle, and a life cycle is made up of different segments. So one of the things we really think about is just that, the applicability of investing in technology throughout a company's life cycle. Early on, companies tend to be higher growth. They spend more, so that is a slice of the pie, right? We have high growth, innovative companies. They tend to be companies that are over investing in sales and marketing. Many of these business models are subscription business models. Therefore, they're incurring the cost, yet only recognizing a certain portion of the revenue. But these are companies that are really trying to build that moat around their business, and we really think in terms of, what does that business look like at scale, when those companies kind of come about. Um, so that, if we think about the portfolio as a three-tiered cake, one of the slices of the cake are, is the high growth innovative companies. Those companies, as they mature, their business typically slows down from a top line perspective, and they become more GARPy oriented. The GARPy companies are companies that are more mature in their life cycle. They usually are at a scale aspect of their business and generating really good profits and free cash flow, because uh, they're not having to invest as aggressively to build that moat. So that's a second tier of the tie. So these GARPy companies, and then a third tier of the cake are these kind of attractively oriented optionality company. And I would put, this is interesting to me because I would put, a company like Salesforce.com kind of between GARP and, an attractively valued company with optionality, in that it is a scale business. They haven't had a whole lot of discipline around spend, but now they're getting that discipline. So, there is this kind of natural progression of life cycle for tech companies. In fact, we talked about it yesterday. I had a board meeting with the board of the trust, and we were talking about, just how companies go through multiple iterations as they kind of begin this journey from being kind of birthed as an IPO, and then kind of what does that journey look like. And look, at the end of the day, I want to be really clear here. We're only interested in businesses that have long-term profitability characteristics. I meet with lots of companies I think are interesting. I look at the sector and I realize it's just profitless prosperity. There's too many competitors. There's not enough margin dollars to go around. But this gives us a framework of kind of thinking about the portfolio, thinking about a portfolio that is, characterized not only from a subsector product perspective, but also from a stylistic perspective. And depending on the market, we'll have various weights in these three sectors. So this is shows us, the long-term trailing PE ratio of technology relative to the S&P 500. And just so you know, those of you asking questions, I will get around to them after the presentation. But appreciate, and I definitely keep firing the questions. If you look, and I lived through the .com, and I would make the argument that, shipping dog food, bulk dog food across the internet with a browser isn't the best idea. So, just because a company has a website doesn't mean it's a good business idea. And there were lots of bad business ideas during the .com, and I lived through that. And there was a real disconnect between the valuations and the S&P. Look, today, as we move to the right-hand side, looking, in calendar year today, you'll see that there's a modest premium to technology relative to the S&P 500. But I would make the argument that many of the companies that are embracing technology are creating a competitive advantage. So it doesn't surprise me that technology trades at a premium to the S&P, and I feel that's really warranted if you just think about the inherent growth characteristics of a company, like a Microsoft versus a Campbell Soup, right? I often remind myself that, the inherent growth opportunities in tech, from a durability perspective, are longer than many of the kind of core S&P 500 companies, just from an acceleration perspective. Also, from a margin perspective, these businesses at scale are really appealing businesses, given that, a lot of times you invest heavily and then you just continue to sell that product or that subscription again and again. So this shows us, so you might be asking yourself, so why am I why am I even, talking about technology? It's been such a tough neighborhood. It's been so kind of difficult the past couple of years. And here again, thinking about a multi-year journey, I think it's important to realize that, the valuations today we're seeing in software, you have to roll the clock back to 2017. Okay, so I'll make the argument that, yeah, did things get overheated? Absolutely. Are we at a trough valuation today from an EV to sales perspective? In my opinion, we are. Especially if I remind myself of the context, right? If you just think about companies and your own use of things like software today versus 7 years ago, it's materially different, and many of the companies that you interact with on a daily basis are using these products to make their products more. They're using them to make their customer service better, sell more things, and decrease costs. And that triumphant of being able to do that vis-a-vis software really makes some of these companies key ingredients to business competition, sorry, business differentiation for the companies that use them, and creating that competitive advantage. So I look at the valuation today, and I think that that 23 and 24 are setting up to be really interesting years for some of these companies. I will tell you, we've seen dispersion, and I think that's great, because dispersion means that we're able to kind of pick and choose the winners and losers within the segment. Um, what's exciting about tech today, and just understanding that as the portfolio manager of the trust, that I'm constantly working with my team, and as we kind of think about, like, what are the areas that we're excited about, and what could be a secular theme that allows us to really kind of own these businesses for multiple years, and participate in that price appreciation. Well, some of the larger themes, and we'll go into more depth as the presentation goes on, but some of the larger themes are things like cloud computing, right? This notion of companies moving their infrastructure from this kind of an infrastructure that they own and manage, to outsourcing it to cloud providers, right? You're moving it from a fixed cost environment to a variable cost environment, and you're not getting stuck with any of the stranded costs of technology obsolescence. That's a real win for the company, in my opinion. It allows companies to basically focus on what do they do well, and not get stranded with this infrastructure that becomes obsolete. I can remember, when I worked at Oracle, we spent a lot of money, a lot of R&D dollars in our applications on just orchestrating the infrastructure beneath it, and that's really not value add to the customer. So cloud computing is still fairly nascent. Artificial intelligence is something we've heard a lot about this year. I was just meeting yesterday afternoon with Cadence Software, which designs emulation and simulation software, primarily for systems and chips. And we were talking about artificial intelligence and kind of what it means, not only to their business, but what it means to their customers, as customers kind of start to build out these systems to handle these multi-node models, to try to participate in the artificial intelligence the artificial intelligence aspect of their business. I mean, that's going to just require billions upon billions of dollars of investment in things like chips, investment in things like comm equipment, and then obviously you need to be able to design those chips, design that equipment. So there's a whole ecosystem that's going to be born around artificial intelligence. Cybersecurity. I don't think I need to spend a lot of time on this call, but I think everybody who uses a digital technology understands the importance and the relevance of cybersecurity, and just kind of how pervasive it is in our day-to-day lives, and how sophisticated the adversaries are. The adversaries are well-funded state organizations that really kind of see cyber warfare as a way to garner state secrets, and create competitive advantage for their country. So, as great as our digital lives are, and they really does make your life more efficient, more effective in some level. There's also a risk, right? There's a risk that with that becomes this persistent worry about cybersecurity, and therefore companies need to spend aggressively. We're seeing electronic vehicles, not only the movement to hybrid, but the movement to EVs. I think that that journey is just in the beginning, and they're gigantic ecosystems that need to be created, and we're investing in a lot of them to really facilitate making sure that the electronic vehicles and the hybrid vehicles have power management systems, have EV management system, or sorry, battery management systems, et cetera, et cetera. And then lastly, there's this kind of Internet of Things. And then this idea that we're living in a world where almost every device that many things will be connected to the internet, and as they're connected to the internet, that data comes back and allows companies to optimize around that particular that particular process, that particular function. So these are some of the drivers. We'll go into a little more detail here. So just kind of looking at cloud computing, look, every 15 or so odd years in technology, you have this transition, and you have a transition to a different platform. The movement to the cloud is starting, or has started is the correct statement, and it's a journey, but it's a journey that organizations are going to take, primarily because they're getting questions from their upper management around how do we decrease our costs and increase our flexibility, and moving to the cloud really helps do that. So fairly nascent still. If you look at the percentages, we're still not seeing a ton. A lot of the spend is still, it really kind of hasn't hit that kind of inflection point, but we're getting closer and closer. And that's a real that I believe that's probably a 10+ year growth horizon, for the movement to the cloud. And there are just lots of different ways that we can participate in that. This is just the journey, and this is the journey I've kind of participated because I'm older. I got into the business when we were doing client server. As I said, every kind of 10 to 15 years, depending on, you see this movement of platform. So we've moved from client server to the internet, which led us to mobile, which led us to big data, and now we're looking at artificial intelligence. And at every step along the way, companies have to rethink their business, and to try to figure out how do they participate in kind of what is going on, and what can they do from a technology perspective to make sure that they are using the latest and greatest technology to kind of to facilitate their business. So artificial intelligence very much top of mind. I've read a lot about it over the past kind of 6 to 9 months. And I think that the important thing I like to remind investors is, without cheap compute and storage, it wouldn't happen. It would just be too expensive. And by the way, the costs still need to come down. But we're living in a world where companies are able to look at these massive data sets, and be able to run model after model, run multiple algorithms against those data sets in order to kind of optimize each aspect of the model, resulting in kind of a kind of a generative learning for their systems. So I think this is really interesting. Cybersecurity here again. This is a place where you just have just this constant vector change by the adversaries, right? They'll try to penetrate an enterprise a certain way. They'll change vectors, and therefore, from a company perspective, you need to have this kind of a layered approach to security, an approach that requires investments at multiple layers within the stack, making sure that you're protecting your business from the bad guys, or from the bad people, not bad guys. So here again, there aren't too many sectors I deal in that have this type of growth rate. I mean, 12.6% until 2030 is just a phenomenal growth rate. And these just shows you the various subsectors within cybersecurity. So that's a very exciting space for us. As I alluded to on EVs, and you can just see here um, that that the movement to electronic vehicles is real. I don't think there's anyone on this call that probably doubts that. It was interesting. My mom, who will be 80 this year, it was looking to get a new car, and she'd never, she always calls me about new cars, and she said, I really want to get a Tesla. And I said, Mom, why would you get a Tesla? And she kind of went through the reasons, which were really valid. We went and test drove Tesla, which, by the way, if you haven't driven one, and I'm not, trying to be a paid advertisement, I was amazed what a great driving experience it was. So, I think that's just indicative of somebody, who's, going to be 80 in a couple months, thinking about, her next car and what type of car that is. So I think the movement to EVs is real. I think the movement to hybrid is omnipresent, and as we move there, there's just more and more semiconductor silicon content in these vehicles because as they start thinking about not using a combustible engine, they move a lot of their systems to more energy efficient aspects. So this just kind of shows you the amount of content, and I think that if we just think about our lives and just how digital they are, and we're just having more and more data, right? And I don't think, here again, I don't think I'm telling you anything you don't know, but we live in a very digital world. Digital from a business to business perspective, digital from a consumer to business perspective, and with all this data comes the opportunity for companies to really look and try to figure out what can they do better for their customers, and what products and services can they optimize by having all this information. So, I think that COVID, I think that the pandemic just kind of brought this to the forefront. If I think about my own experience, with respect to just shopping, I still go in stores, but I can tell you almost, 90% of the time, I'll go on a company's website prior to going in the store, or just to kind of better familiarize myself. So I think we're living in a world where if you're a business, you really need to meet your customer where they're at, and that tends to be in the digital realm. And therefore, we have kind of all these connected devices and all this, the digital aspect, and businesses, both business to business and business to consumers, need to respond to this, and therefore, that's a great opportunity. So, I want to spend a couple minutes talking about the global labor shortage, and why is that a driver for technology. um, you know uh, Post the pandemic, and even prior to the pandemic, there were challenges getting enough workers, and post the pandemic it's really been exacerbated. So what we've seen that here in the US, and I think it applies to most tier one industrial, sorry, most industrialized countries, that as our population growth has slowed, we have worker shortages, and we have an imbalance. And many times when you have these imbalances, technology has stepped in to kind of fill that gap by making employees more efficient, or making them more productive, which is the same thing. So if you look at the US, right, I mean, this just kind of shows us, it shows us the overall population, the working population, and how that's decreasing, and that's actually gotten worse post the pandemic. Same thing exists, in a global level. I mean, it's just surprising, that this is the first time since 1973 we're going to actually have a labor shortfall, and that creates many challenges for businesses, right? And if you think about during these labor shortage periods, traditionally technology steps in and it becomes a larger percentage of spend, a larger percent of GDP, in order to solve those labor shortages. So if we go back historically and you look at technology spend as a percentage of GDP, we've seen that there's been a real acceleration of spend of technology during these times. And I don't see an easy way to get more people. A, changing birth rates is difficult. B, a lot of people post the pandemic have decided that they want to exit the workforce. So our belief is that technology is going to step in and provide many of the tools that'll make people more efficient and make their jobs easier and allow companies to be able uh, to be able to spend um, to spend more on GDP, more technology as a percentage of GDP. Sorry, I had trouble getting my words out. So lastly, just kind of thinking about our investment philosophy, and then I'll let you guys go. We're a multi-pronged investment fund. We look at multiple sectors. We have a focus on risk, making sure that we have not only risk across style, that we're cognizant of style risk as well as subsector risk. And we believe diversification is really important for the fund. So we make sure that as we think about our investments, we look at kind of not only just kind of listening to companies report, which anyone can do, but also, meeting with suppliers, meeting with system integrators, et cetera, et cetera. So this idea of creating an investment mosaic for the trust as we kind of go down the investment path. So we can just run through the portfolio in quick manner. 40 to 70 stocks, very active. We tend to be focused on mid-cap growth. We tend to have higher turnover than other funds in that, what we realize is there are many times in technology where, your thesis is wrong, and, better off to sell that stock than kind of live with I think technology can be really brutal for laggards in certain subsectors. So I can go on here, or we can stop for Q&A. Yeah, let's do this really quickly. I saw the person come on, so I'm trying to be cognizant of time. So these are our top 10 holdings. As of the end of January, you'll see a variety of different companies that are represented there. You'll see some of the mega caps, but you'll also see some mid cap growth companies. We own Meta right now in a fairly large weighting. That's a new position for us prior to their reporting the quarter. We were able to kind of pick up on some interesting things. And I think Meta is an interesting turnaround stock at this point in their life cycle. But you'll see things like, auto semiconductors represented by ON. You'll see, cybersecurity in the likes of a Palo Alto Networks, Paycom Software, which is an digital HR system. So fairly diverse portfolio encompassing lots of different aspects of the value chain. Just kind of no surprise here. We tend to be benchmark driven, but not benchmark aware, but not driven. Underweight mega cap, overweight mid and large cap. That tends to be where we cut our teeth. And that's the end of the presentation. So I'll go back here to start the Q&A. I don't know. I'll let somebody cue me in as to if they're going to read the questions or how we go about doing it. But I want to remind people, that mid cap oriented fund really focused on the key themes in technology, benchmark aware, not driven, and really think about your investment in the trust as a multi-year investment. I think that's the best way to kind of capitalize on our success.
Thanks, Mike. That's been really interesting. As you can see, we've had quite a few questions in. We've had a few come through offline as well. So we'll see if we can group those together and square them off. I think the best place to start actually is talking about that weight in the US. What is the trust up to now in the US weighting, and how are you balancing the sort of opportunity set in the US with that need for diversification in the trust?
Yeah, so I like to remind our investors, and let me see, there's a slide in the appendix, or there usually is. Yeah, so let's go to this slide. So first of all, I want to remind our investors that many of the companies are headquartered in the U.S., yet most of them have international revenues, right? So it's a little bit like saying that, back in the day, Glaxo, which was headquartered in the UK, yet derived most of its profits out of the US. So I do think that corporate HQ we're living in a global world, and these are global companies that participate on the international front very aggressively. So I think it's a little bit of a misnomer. Having said that, for a lot of companies, as they begin their journey, a lot of them, may have been located elsewhere, but relocate to the U.S. primarily because there's just good access to talent and capital. So, I'm not discounting the fact that they're located in the U.S., but that tends to be where a lot of the tech companies actually are. We are not U.S. centric, even though the weighting would suggest that we are. I actually spend time looking at companies all over the world. It just so happens that a lot of them in the sectors we're really interested in today happen to be headquartered in the U.S. With the caveat, there's a large international component to most of their um, international revenues.
Thank you. There's a couple of questions that we sort of put together a little bit. Have higher interest rates caused you to look sort of later in that tech life cycle of the trust? And also, what valuation methods do you use to avoid investing in those high growth companies that will never achieve profitability? And similarly from that, have you learned any lessons from the recent falls because of the
Yeah.
higher interest rates?
Yeah, great question. So obviously, as one of the things we did, and we didn't do enough of it, was as interest rates were going up, and we actually started in June, June of 20 June of 21. We started looking at valuations, and we just couldn't get the math to work, and whether the company was going to beat revenues or not, it didn't matter because there was just no room to play. And we started tilting the portfolio back towards a more value tilt. We clearly didn't do enough, but we're cognizant of the fact that if something's trading at it in an extreme multiple, um, you know, and at the time I can remember Walter walking in my office, and he and I just went through the portfolio, and we just couldn't get the math to work on a number of names, and we sold them not because the fundamentals were bad, because we sold them because the risk reward was bad. So as interest rates go up, that is a cost of capital increase for the companies. And one of the things we did last year was really to go through the portfolio and really understand at a company level, were they acknowledging that their cost of capital were going up? And some of the companies were very cognizant of it, and some of the companies were not cognizant, or put a different way, didn't really care. And the companies that didn't really care, we really couldn't underwrite those businesses. So those are businesses that we exited. Here again, not enough of them. But I think the one thing that I'm very cognizant of, and it is a lesson learned, is that at the end of the day, if you're not creating value for your customers, right? If you don't have a good repeat sales number, if you can't grow your installed base, that anyone can grow sales and marketing that leads to revenue growth, and that is the definition of me for me of profitless prosperity. And I do operate under the premise that lots of companies go public in the world, but the very few great businesses go public. And you just have to remind yourself, as you look at a sector and think about what are the barriers to entry, what is the durability of that sector. And I understand with technology you don't always have the durability aspect. It's difficult to look out at times, 5+ years. But I do think that you're able to look at business models, and be able to say to yourself, what is give based on the competitive landscape, what should the margins be? And I think we're good at that. In that, in my case, I come out of industry, so I approach it from a very much a very fundamental aspect of understanding operationally how a lot of these businesses operate, which allow me, I think, to take those qualitative inputs and reflect that quantitatively. So that's something, we've been focused on for a long time. And we've avoided lots of businesses we didn't think were, very interesting sectors. I think the lesson I've learned um, is that, when you get to certain multiples, it doesn't matter how good the business is. You just need to trim the stock or sell the stock because it can't persist. Primarily because the math doesn't work. As companies have a law of large numbers, they can't grow as fast. So justifying that valuation becomes harder and harder. So I'd say the lesson is probably just, better discipline, when things are going well would probably be the biggest lesson takeaway.
Really
Did I
useful.
answer,
Thank you.
did I answer all those questions?
You did, yeah. Valuation methods, higher interest rates, and lessons learned.
Well, from a valuation method, just so people understand, at the end of the day, businesses need to generate cash. So, even though we may use an EV to sales multiple, sorry, I'll use an enterprise to sales multiple early on, so sales to enterprise value. Um, at the end of the day, you have to generate cash as a business in order to kind of to live. So eventually, all of our models turn into cash flow models. Now, I would make the argument that in a subscription software model company that is growing fast, you would be remiss using a cash flow model day one, primarily because the accounting is such that you're losing money on every transaction because you're incurring the cost of sale, yet you're only recognizing a sliver of revenue. Now, that model turns itself on its head after a couple of years. But early on, therefore, early on for businesses, we may use things like, enterprise value to sales. We may use other metrics. But at the end of the day, it really boils down to cash flow generation for a business from a valuation perspective, and making sure that those cash flows, should flow to shareholders.
Hmm. Thank you. That quite neatly leads us on to another question we had actually about firms maintaining pricing power with sort of the increase in inflation that we're seeing. Some of the more dominant firms are able to pass on price increases to customers, but is there a concern that consumers will start to look for alternatives? And are firms like Microsoft going to be fine, but alternatives, sort of smaller players, aren't going to be able to do that?
Yeah, it's a great question. So look, I think that you can't pass on prices indefinitely to your customers, and therefore, I think you as an organization have to become more efficient, right? I think that there's a quid pro quo between buyer and seller. And look, some pass on may be okay, but you need to run your business in a more efficient manner, which is why, and I'm not trying to sound like a broken record. It's why I remain kind of optimistic about technology, because a lot of these businesses, and we've seen a real first step by many this past, as companies reported, what was calendar Q4, you saw a huge swath of companies really talk about, hey, look, we're going to run the business differently. We're gonna run it more profitably. And I think that part of that is inflation, and part of that is just kind of thinking about the cost of capital. But you can't, I don't think, I don't think businesses can pass on, inflationary pressures indefinitely. I think that businesses will have to relook at how do they actually construct their products and services, and they'll probably use technology as part of that look. So.
Thank you. And then let's perhaps turn to some of the more specific questions. We've seen quite a few layoffs in the US tech sector. Obviously, it ran up quite a lot with huge hirings. Do you think that the layoffs have now finished? And do you think that will be a good thing for the sector?
Well, the interesting thing from my perspective is, when you see the likes of, Facebook and Amazon and, Google, all these big companies lay off employees, they actually allow some of the smaller companies, some of these more mid cap growth companies, to obtain talent that they probably couldn't obtain. So look, I think that most businesses that are growing aggressively tend to hire in front of that growth, right? Because at the end of the day, I often remind myself, factories relied upon, if we are an automobile factory, we relied upon iron and steel to build our cars back in the day, or whatever, even today. But a lot of these tech companies, the widgets are people, right? I mean, it requires people to make the machine work. And therefore, A, I think that it makes sense that they rationalize their headcount, and B, I think from selfishly, and I've talked to enough CEOs now to know that they're seeing candidates for some of these businesses that they haven't seen in the last 4 years, right? Because so and so is going to the hottest tech, one of the big tech giants, getting paid a really really good wage with great options, and I might add very little risk associated with that job, versus going to a smaller company. Now these smaller companies are actually seeing a talent pool, and I think that's going to pay off. It's not going to pay off this year, but it'll pay off over the next couple of years, because there's a kind of rule of thumb that one great developer attracts 12 other developers to an organization from an engineering perspective. So I think that some of my companies are gonna end up with a talent pool that they probably never thought that they would get, that they would obtain. And look, at the end of the day, I think that many of the layoffs that we've seen are I don't know if they're over yet, but I have heard consistently that people are being reemployed fairly quickly. So I don't feel like you're going to see a lot of software engineers on the street, because just the demand. I mean, the demand for not only tech, but remember, there's also a huge demand in Main Street and for Main Street businesses to obtain these people. I mean, there are literally 700,000 job openings in cybersecurity in the United States. Okay, that is a daunting number, and I think it's 1.2 million worldwide. Like, that's why we're excited about cybersecurity, right? Like, the adversaries never stop, and there aren't enough people to kind of run the system. So I do think that people will be redeployed, is my guess, and it could end up being a good thing for some of the companies we invest in.
Thank you. We have officially hit time, but I don't want to keep you from your breakfast, but we've got a couple more
And
questions
I
we
can
would
go
like to
on.
through. Okay.
I don't want to put
Thank
people to
you.
sleep. So uh,
Well, we've still got, yeah, loads of engagement still going on, which is brilliant. The One of the big stories in tech has been the metaverse. Do you have any exposure in the trust, and what are your views on it? Do you think there's sort of any applications outside of the obvious ones like gaming?
Yeah, I mean, so I am by nature. I tend to think that Wall Street gets really excited about things, and then overreacts on the upside, overreacts on the downside. So I think the metaverse is interesting. I don't have any specific holdings, or we don't have specific holdings um, in the trust. I will tell you that I think that the way to play the metaverse is similar to the way I would have invested in the gold rush, which is I'd prefer to own picks and shovels versus the actual mines. So I think that that you think about the beneficiaries. And by the way, I do think the idea of a Schneider elevator repair person, service person, going out and being able to visualize what that repair should look like vis-a-vis a set of goggles is really really interesting and really applicable. But I just don't know if we're there yet. I don't think people are going to walk down the street with VR goggles on, because I think that this little device, which is the iPhone, is really easy to check things on, right? I mean, you can be in a line at a coffee store, you can whatever browse to TikTok, you can go to Instagram, you can text your significant other or your family. I think the goggle thing for me just feels a little antisocial, but I do see applicability. I think that I think from a repair perspective, I think it's interesting. I think from a medical perspective, I think it's really interesting. But is it going to be as ubiquitous as some people think? Yeah, I'm a naysayer on that today. primarily because I think the form factor is too high. And I'm not interested in buying a piece of real estate in the metaverse, with my cryptocurrency to be able to prove to somebody with a set of VR goggles that I have a nice. I don't, and maybe I'm too old, but I'm going to keep my ear to the ground and keep talking to young people to figure out what's going on there. So
Brilliant, thank you.
TBD.
Um, and we'll try and sort of end on a more positive note. The pandemic brought forward a lot of tech use, but this is unlikely to reverse, yet share prices have come off quite sharply. How long until the market begins to realize that they're perhaps undervaluating share prices and go through reevaluation? And is this encouraging you to spend any cash?
Yeah, so we're at a reasonably low cash balance. I do feel like 2023. So I think for a lot of companies, 2022 was very eye-opening. I think it was a real kind of come to Jesus moment with respect to their how do they run their business, how are they more disciplined, et cetera, et cetera. I think we see the beginning results in 23. In that I think that if I use a sport analogy, I think the pitch that the players have been on, they're used to now. So it isn't just kind of companies willy nilly spending money from an IT perspective. I think it's a more challenging spin. And really, the companies that have good products, they'll do fine with that. Sure, and maybe it'll take some a little bit longer at the margin to kind of execute a sales cycle, but at the end of the day, the value of their products there. So I think 2023 is an interesting year, and I think 2024 has an opportunity to be a really good year in tech, primarily because we're going to have easier comps. We will have 1 year under our belt of kind of what the new normal is, and to the point, like no one's using less technology. So you look at valuations, and I'm not advocating it going back to kind of pie in the sky, but I look today and I just go back to that software chart and I just say to myself, at the margin, is the average software product more valuable or less valuable to their company than it was to their customer than it was in 2017? And the answer for almost 90% is yes, the products are more valuable. And therefore, with more discipline, with a more mature model, generating, the companies are going to be generating cash quicker, then I'm optimistic. I mean, I don't feel like, and I feel like I'm not delusional to the extent that I'm not advocating kind of ad nauseum spinning. I think it's going to be selective. I think it's a stock pickers market at a sector level. So I remain optimistic. I mean, I've been in a bunch of meetings this week, and some of the meetings with companies have been exciting, and some of them have been pretty challenging. So you're seeing, and if I had spoken to this group, in 2021 at the exact same time, everything would have sounded great. Every meeting I would have been in would have sounded great. So we're seeing dispersion, and dispersion creates opportunity. So I'm optimistic.
Well, on that wonderful note, we'll draw things to a close. So thank you very much for your time, Mike, and thank you everybody for dialing in and sticking with us.
Thank you. Appreciate everyone's time. Have a great day.
Thank you. We'll be back tomorrow at our lunchtime slot around 12:30, where we'll be joined by Elsa Craig, who is the manager of the International Biotech Trust. If you haven't signed up, please visit the details on the website, on the events page, and everything will be there for you. And just leaves me now to say thanks very much to Mike. Enjoy your day, and thank you, everyone.
See ya.